Hey everyone, welcome back to Statewise Economics. If you are watching this, my Switzerland trip should be wrapping up. I've been soaking in insights from one of the richest, one of the most financially savvy countries in the world. And yes, get ready for some amazing global investing content real soon. But today, let's talk about something super practical. How busy people, yes, you can start investing in 2025 without stress, confusion, or staring at charts all day. Quick disclaimer before we begin, this video is for educational purposes only. I'm sharing what I would do, not financial advice. Always do your own due diligence or consult a professional. Cool. Whether you are juggling a 9 to 5 freelancing, side hustling, or just living your best life, investing can still be for you. You don't need to be glued to the stock charts or be a financial guru to grow your wealth. Let me show you the simplest, most realistic way to get started in 2025. Step 1, know your options and keep it simple. There are two main routes for most busy investors. Number one, self-directed investing. You pick your own stocks or ETFs, also known as exchange traded funds. That's what I do. Two, robo-advisors or professional wealth managers. They do the work for you, of course, for a fee, if you choose professional wealth managers. Now, if you're just starting out, I would personally lean toward a robo-advisor. It's like putting your money on autopilot. You answer a few questions, and the robo builds a diversified portfolio based on your risk level. Simple, low cost, and super beginner friendly. Platforms like Questrade that I use or Betterment in the US, this is not a recommendation per se. Always do your own due diligence. So these platforms, they can make it easy for you to start even with $100. This is not a promotion, like I said, or endorsement, just suggesting you from my own research. Now, step number 2, invest in what you understand. If you are going to do the self-directed pathway, I would consider broad market exchange traded funds like SPY that tracks the S&P 500 index, VTI, which tracks the total US market, or VEQT or QET that is great for Canadian or in one investing. Again, this is not financial or investment advice. These are just suggestions. But the key thing is do your research, look at their fees, who manages the funds. And I've done some videos about these funds on this channel. So make sure you look for the videos that have specific funds and just learn from them. So ETFs are like you're buying little slices of hundreds of companies in one click. It's low maintenance, diversified, and you don't have to guess what the next Tesla or the next NVIDIA would be. Number 3, dollar cost averaging. We usually call it DCA in financial markets parlance. Instead of trying to time the market, which is really hard, trust me, just invest a set of amount regularly, like $100 every month. That's called dollar cost averaging. It smooths out the ups and downs. Some month you buy more if the stock or the security drops, some less if the security goes up, but you stay consistent. Now, step number 4, track your money and don't ignore it. Even if someone else manages your money, like a financial advisor or a fund, you still need to understand how it's working. So I would read monthly reports, ask questions, learn the basics. No one will care more about your money more than you. Number 5, the secret sauce is called compound interest plus time. Hear me again. The secret sauce to success in investing, among other things, is compound interest plus time. You have heard this before, I'm sure. But it's true, money makes money. And then that money makes more money. Again, I repeat this, money makes money. And then that money makes more money. It's boring, yes, but it's also magical. Investing isn't about hype or overnight success, at least from my experience. It's a slow burn. In fact, the earlier you start, even with small amounts, the better off you will be in 10, 20, 30 years from now, if you are investing in fundamentally valuable assets. Again, if you invest in crappy assets, then, or speculative and risk assets, there's a very good chance that you can possibly lose your money. So if you are busy, don't stress. You don't need to pick individual stocks necessarily, or stare at candles all night, or spend the whole day watching what's happening on the market minute by minute or second by second. Just start small, automate it, and keep learning. That's it. And let's be real. Everyone's situation is different, of course. Some people need to build an emergency fund first. Others may need to take all their debt. No shame in that. You do you. The key is start where you are and stay consistent. If this helped you in some way, don't forget to like, subscribe, and share with someone who needs to hear this. And hey, if you want personal coaching or you want to learn how to start investing step by step, check out www.statewise to book for a paid consultation session. And big things are coming. I will be sharing my travel-inspired investing lessons from Switzerland soon. Think chocolate, banks, and how the Swiss stay well. Thanks for watching and see you in the next one. Bye-bye for now.